You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the deep dive. We've got that stack of sources you sent overall focused on global markets, geopolitics, and we're looking at it all through, well, this pretty unusual lens. The ongoing U.S. government shutdown. Our mission today, cut through the noise, figure out what actually happens when, the world's biggest economy sort of goes dark. We're watching markets react in real time, but without the usual lifeblood, that steady flow of U.S. macro data, it's just off.
It really is an informational vacuum. The shutdown has basically wiped the official U.S. data calendar clean for now, which forces everyone, investors, policymakers, you name it, to rely much more on, what our sources are calling policy headlines and cross-asset tone.
Okay, let's unpack that phrase right away. Cross-asset tone. What does that actually mean for, say, the average investor when the hard numbers disappear?
It means you're flying more by feel, by sentiment, rather than by concrete data points. Cross-asset tone is that general feeling, are we risk on today, risk off? That kind of ripples across everything, stocks, bonds, currencies, commodities. When you don't have, say, weekly jobless claims or manufacturing reports to anchor decisions, then those daily political rumors or diplomatic statements, even small shifts in copper prices, they suddenly get blown way out of proportion. Everything becomes headline-driven.
And that pivot, the shift away from data towards currencies, commodities, even defensive trade stuff, that's the core of our deep dive today. We're looking for the signals emerging from this, scarcity. Let's start with the immediate costs. The government shutdown often sounds like just political fighting, but what's the measurable, tangible economic hit right now?
Oh, the cost is immediate.
Yeah.
And frankly, pretty substantial. S&P, the ratings agency, they've crunched the numbers. They estimate this shutdown could be trimming U.S. economic growth by 0.1 to 0.2 percentage points per week.
Wait, hang on. 0.1 to 0.2 per week.
Per week.
That's huge. We usually talk about quarterly growth. To think a domestic political issue is actively shaving that much off, that's a self-inflicted wound, isn't it?
Absolutely. And that immediate uncertainty, it creates a nightmare for policymakers everywhere. They're trying to set interest rates, plan trade talks, allocate capital, all while the anchor of the global economy is, choosing to tie one hand behind its back.
And it's not just economic reports stalling out, right? This domestic paralysis jams up actual diplomatic gears, too.
That's exactly right. Our sources mention crucial logistics around the U.S. president's planned Asia trip have reportedly stalled, even though the diplomacy itself keeps moving. Japan's still aiming for that October 27th visit. South Korea and the U.S. confirmed agreement on security cooperation. Brazil and the U.S. are planning a bilateral meeting. So the goals are still there, still urgent, but the actual machinery of government, the implementation, is seizing up. Lack of funding, personnel.
Okay, so let's pivot to the markets themselves. DC paralysis is starving global markets of data. Where does the money flow when that happens? Which brings us to currencies, foreign exchange. And here's where it gets really interesting. The U.S. dollar, it's softer, predictable maybe. Fifth straight session down. Markets just can't gauge how long this shutdown lasts.
Yeah, the soft dollar, that's kind of the classic response to this sort of domestic uncertainty. But the really fascinating story, I think, is over in Asia, the Japanese yen. It's leading the G10 currency gains right now.
Okay, the yen is often a safe haven, but you're saying this is different, not just standard risk-off.
It feels fundamentally different this time.
Yeah.
And it's because of very clear guidance coming from the Bank of Japan.
Okay. Tell us more. What did the BOJ actually say? How is Japan setting the pace while the U.S. is kind of stuck?
It really comes down to conviction, it seems. The BOJ's Uchida came out and explicitly stated the bank intends to keep raising rates if its current economic outlook holds. Now, the market sees that as a real, deliberate, sustained move away from Japan's, decades of emergency low-rate policy.
Right.
So the yen isn't just strengthening because the world feels a bit nervous. It's strengthening because its central bank is finally giving a clear and frankly more attractive direction.
So you've got the perfect contrast. The world's reserve currency, the dollar weakening because of internal self-imposed gridlock, while a major Asian central bank provides strong, credible guidance and its currency moves up. That's central bank divergence playing out right there.
Exactly. And that divergence shows where confidence, maybe liquidity too, is flowing globally right now. If you look quickly at the other majors, the euro's been remarkably steady, actually. It's sitting there above 1.17. Sterling is modestly firmer. Looks like it's getting some support from domestic surveys pointing to slightly higher inflation expectations down the road. More local factors, maybe.
And what about the commodity currencies, the Aussie and Kiwi dollars?
The Antipodeans, yeah, they're generally showing slight gains, kind of staying in the green. But the moves are pretty contained. And that's largely because China's been on holiday.
Ah, Golden Week.
Right. So with that huge trading partner offline, you've got thin news flow, lower trading volumes. It just caps any big swings for AUD and NCD. Their fortunes are so tied to Asia.
So bottom line for navigating FX in this weird environment.
I think the key implication is speed and volatility. Because we're missing those big U.S. reports like weekly claims, which usually absorb minor news.
Right, they provide context.
Exactly. Without them, the bar for a headline to cause a big swing is incredibly low. Any whisper out of Washington, any firm statement from another central bank, it can cause these really large, rapid moves. You have to be nimble.
Okay, let's switch gears to commodities. They seem to be telling two interesting stories. Haven demand, but also some surprising industrial resilience.
Yeah, starting with gold, the classic haven. It's really capitalizing on all this uncertainty. It's paused its big run up a bit, but it's still hovering near record territory. And that's underpinned by, well, the softer dollar, obviously, and just general policy uncertainty fueling that safety bid. But here's a really interesting detail. One major bank just reiterated its medium-term bullish calls on gold. They're flagging upside risks, even to their 2026 targets.
Hold on, 2026, that's 3 years out. If a major bank is setting targets that far ahead, are they suggesting this uncertainty is deeper, more structural than just this shutdown?
That's exactly how it reads. The 2026 target suggests investors are pricing in something more systemic. Could be long-term inflation fears, maybe geopolitical fragmentation, or maybe just a basic lack of faith in major powers to keep things stable. It feels like the market is preparing for a world where gold plays a more central, permanent role as a store of value, beyond the daily news.
That's a significant shift in perspective. Okay, but what about the industrial side? Copper. Dr. Copper, the economic barometer, usually so dependent on China.
Copper has been showing remarkable resilience, actually. It's pushed higher, extending gains above that key $10,500 per ton level. And the really surprising part, base metals are holding this line, even moving up a bit, without full participation from China because of their holiday.
So where's that demand coming from then, if not the biggest buyer?
Well, it suggests either pretty resilient demand from maybe Europe or the US, or perhaps inventory building tied to specific projects like infrastructure, or maybe global supply is just tighter than we thought. Either way, it signals a stronger industrial pulse than you might expect, given the political noise out of D.C.
Okay, before we leave commodities, let's quickly touch on energy. Crude oil seems a bit different from gold and copper, kind of fighting off the uncertainty.
Yeah, crude started firmer in recent sessions, but those pops tended to fade pretty quickly. Traders seem to be reassessing the immediate geopolitical risks rather than broader economic sentiment. It seems more sensitive to near-term supply news. For instance, we saw Kazakhstan, a key producer, projecting output near 90 million tons in 2026 while they work through compensation plans. It suggests major producers are still focused on those longer-term output goals, which adds maybe a bit of stability to the outlook.
Okay, so zooming out, we've got missing U.S. data, shifting market focus. What does this all mean for global trade? Geopolitical strategy? Are other countries using this moment of U.S. distraction to put up their own shields?
It certainly looks like a time for defensive moves. Take Brussels, for example. They're apparently preparing a draft proposal now to lift EU steel import duties up to around 50%.
50%? Wow. Why?
Well, you have to see it in context. The stated aim is to align EU rates more closely with North American levels. It signals that global trade norms are definitely shifting. Europe seems to be acting defensively to protect its own industries, especially if other major players seem unstable or are turning inward.
That feels like a direct reaction to trade friction. And speaking of trade effects taking time, our sources had an interesting point about South Korea, didn't they?
Yes, that was very insightful. A Bank of Korea official observed that the really significant structural impacts of U.S. tariffs on South Korean exports, they'll likely show up more clearly next year.
Not immediately.
Not immediately. It's a crucial reminder that trade restrictions often have a really long fuse. Governments act now, but the real economic adjustment, the pain on balance sheets, often lags way behind the headlines.
And sticking with geopolitics, we also saw some key moves related to Europe's eastern flank, connecting intelligence and trade tools.
Yeah, it looks like a very calculated, dual approach from the West. First, the U.S. is reportedly formalizing intelligence support for Ukraine, specifically for longer-range strikes inside Russia. And they're encouraging NATO allies to do the same. That's about boosting battlefield capability.
And the economic link.
The G7 strategy explicitly ties that battlefield reality to economic pressure. They emphasize using trade tools, tariffs, targeted bans to squeeze Russian revenues. But it's not just blanket sanctions. They're trying to keep it aligned with two big constraints: the evolving needs on the ground and, crucially, the stability of global energy markets. Maximum economic pain, but with controlled energy risk. It's a long game they're playing.
Fascinating stuff. Okay, so to try and pull this all together, we've seen the global market really pivot away from that traditional U.S. data signal. Sentiment now seems guided by clearer policy signals elsewhere, like the decisive Bank of Japan versus a paralyzed Fed, and these simmering geopolitical tensions showing up in new tariff plans, and that structural demand for havens like gold.
Exactly. And that structural shift really dictates what we need to watch closely now. The key drivers for sentiment in the very near term are still going to be: 1, the yen's reaction to any future BOJ guidance that's providing direction; 2, copper's ability to stay resilient even without China fully back online; and 3, above all, any hint, any timeline on the U.S. shutdown ending. That's what could restore that desperately needed data signal. Until then, expect more volatility.
So given everything we've covered, the fact that a purely domestic political event, the shutdown, can knock 0.1 to 0.2 percentage points off U.S. growth per week, stall international diplomacy, and prompt major trading blocs like the EU to immediately rethink tariff strategies. What broader assumptions about global economic stability, maybe even the reliability of major governments, are we now forced to fundamentally question? Something for you to think about as you process these shifts.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.